Hello and welcome. In today's class, we'll discuss about the supply of money. In the last video, we have learned about the demand for money, and by demand for money, we have also um, learned that it's based on two motives: the transaction motive and the speculative motive. Transaction motive or transaction demand for money is where people need money for meeting the daily needs, and to make that transaction they need money, they demand money, and that money depends on income. The higher the level of income, the higher will be the quantum of transaction. And we all know that out of income we do save, and saving depends on rate of interest. So if the rate of interest is high, saving will be high. So that's why people would like to save rather than keep money liquid at hand. So that's why the demand for money, the transaction demand for money will be low. On the other hand, if the rate of interest is low, people would rather hold money than save. That's why there will be the high transaction demand for money. So there is a direct relationship between transaction demand for money and the interest rate. And the second motive is the speculative motive, where people would like to hold money in speculation of a profit by holding bond instead. And bonds, we say, is also depends on the rate of interest. The price of bond is inversely related to the rate of interest. Higher the rate of interest, price of bond will become low. That means it's cheaper to buy. That's why people will demand less for money. Speculative demand for money will be low. On the other hand, if the rate of interest is low, the bond price high, people would like to hold money rather than holding bond. So there's a high speculative demand for money. So that's the demand side. Today we'll talk about the supply issues, the currency of the country. That is the first function, issuing of currency. It's the sole authority, the only one in the economy to print and issue money. So that's why that answers to our question: who supply money? It's the central bank by printing currency and issue for the country. Number two functions, if we may note, it controls money supply. It supply and it controls at the same time. And how it controls, it has the different methods, the instruments like the bank rate, the open market operation, the variation, changing the reserve ratios like the CRR, the SLR. Number three function is it acts as a banker to the government. It may loans to the government in times of need. Number five, number four is the custodian of foreign exchange reserves. Whatever we earn from foreign trade, that reserve is with the Reserve Bank of India. And also it acts as a bank to the banking system. It is the banker to the government, it is the banker to the commercial banks at the same time. So these are 1, 2, 3, 4, 5 functions we may list of the central bank. But for this topic, we concentrate on the first function because we talk about the supply of money. Supply of money, we understand the issue is from the it's done by the central bank or the reserve bank, as in the case of India. Okay, so when central bank issues these currency, they can be circulated in the market, held by the public, or as savings in the commercial bank. All these are called high-powered money or reserve money or monetary base. Okay, so that's about central bank and its function. And the most important function is it issues currency. Without it, there will be no currency in circulation. And there are also other banks named commercial banks, so many of them. They are also very important in money creating activity. They act as a part of the money creating system of the economy. Of course, they cannot print money, they cannot issue money, but they help in credit creation. We will learn about that, but at the moment, let's try to stick to what's its role and function. The function is number one, they accept deposits from people, public. We may have surplus money apart from spending, so we want to save. Commercial banks accept our deposits. And out of that deposit, the second function is it lends out part of these deposits to those who want to borrow. So the acceptance of the deposit is the first function, and lending is the second function, or giving loan. So when it accepts our deposits, it gives us the rate of interest in return. The interest rate paid by the banks to the depositors, you save, you get the interest rate, but the interest rate we get is lower than the rate charged from the borrowers. When it loans out, it also charge those who take loan, but it charge higher than what it gives to those who deposit money. So the difference between these two types of interest rate, the interest rate that it charges from the borrower and the interest rate it pays to the depositor, is called the spread. And this spread is the profit that's owned by the central bank. So this is like a business. That's why it's called a commercial bank. Two main functions. That's how it multiplies the supply of money. So it's the role of the commercial bank to create credit so that central bank can issue currency, issue money. But of course, we have also learned that the central bank can also monitor, can also control that supply of money exercised by these commercial banks. Okay, so how commercial banks go about in its activity of accepting deposits and granting loans is that people have some people have excess fund, some people needs fund for business. So commercial banks mediate, it acts in between um, individuals or firms with excess funds and lend to those who need fund. It takes from those who have surplus and loan to those who are in need. People with excess funds can keep the funds in the form deposit in banks, and those who need funds borrow in the form of home loan, crop loans, etc. People prefer to keep money in banks because banks offer to pay some interest and on any deposits made. When you save, no matter how little it is, you earn a return. Also, it is safer to keep fund in the bank, save in the bank rather than at home. So that's why commercial banks are important institution of taking care of our deposits and at the same time paying the interest if we deposit. And in the modern context, when we save, we open an account, checks are given or debit cards. Having a demand deposit makes transaction more convenient and safer even when you do not earn interest. Sometimes just because it's safe, we get checks, we get debit card, ATM cards, we can withdraw our money, demand our money at any time. So even if we do not earn, we rather save in the bank than keep at home. So that's the importance of commercial bank. Okay, so when we save, funds get accumulated with the bank will loan out those money to those who are in need to invest. That's why it'll charge from them more and pay to us lesser than what it charged from them as interest. So assuming that not everyone who has deposited funds with it will ask for the funds back at the same time. When we deposit, not all of us will go and withdraw at the same time. So the bank can loan these funds to someone who needs the fund at interest. So that's why it'll keep some and loan the rest, knowing for sure that not all will come at the same time and withdraw all the money. So there will be some reserve with the bank. So the bank will typically retain a portion of the funds to repay depositors whenever they demand, whenever they want to withdraw, and loan the rest. That's what its business. It's taking and loan so that it will be able to earn more. Since banks earn interest from loans they make, any bank would like to lend the maximum possible. So more loan they make, more will be their earning in terms of interest. So that's why they want to to earn more and more by giving the maximum loan. But there is a limit to it. It's not it because it has to repay the depositors whenever they come and withdraw the money. So it has to keep in mind that it has enough fund to keep aside after given loan to meet the needs of the depositors. A bank must balance its lending activities so as to ensure that sufficient funds are available to repay any depositor on demand. So whenever they need money, it must have at its disposal that amount. Otherwise, people will doubt the integrity of the bank. So now, knowing those two types of banks and its functions, we come to the part where we'll sum them all together. That what we have learned is that the money supply by the Reserve Bank, by the commercial banks, they consist mainly of currency notes that are in circulation, that are at hands, or coins issued by monetary authority. In India, RBI, coins are issued by government of India. Apart from currency notes and coins, the balance in savings or current account held by public in commercial banks also considered money, since checks drawn on these accounts are used to settle transactions. That means, what are the different money supply? The different money supply consists of currency notes, currency coins, and then savings in the bank, saving bank accounts. Those are money supply because we save it money. It becomes a deposit, but we also get a check that we can withdraw, so they are part of the money supply. And those deposits that we can withdraw on demand, they are called demand deposit because we have checks, we have ATM card, we can withdraw any moment, anytime we need. That's why it's our money. Those deposits are demand deposit. They are part of the money supply. And there are other deposits, however, like fixed deposits that have a fixed period of maturity that you cannot withdraw before the maturity date. Those are called time deposit. So we have demand deposits, we have time deposits apart from the cash in hands, currency, and the saving. Okay, so those are the supply of money. Who supply this money? You understand there are two main institutions, but what are the different forms? Can currency notes, coins, savings, can be current account, these are demand deposits, or can be fixed deposit or time deposit. And according to RBI, to define this money supply, we have to differentiate between narrow and broad money. Okay, all the money that are in circulation, all the money that is being supplied, they can be narrow and broad. The total stock of money in circulation among the public at a particular point of time is called money supply. Whatever is being issued, that stock that are in circulation, they are money supply. But there are different measures of money supply. It can be M1, M2, M3, and M4. The difference between these are that M1 is equal to CU plus DD plus OD. CU is the currency held by the public. You have money in your hands at home. That is the currency, notes and coins. They are money supply. Money that has been supplied. You hold that money supply. But the M1 also includes not money at hands, but also the DD, the demand deposits that you keep it as a saving with the commercial banks. So CU plus DD, money at hands, money at the commercial banks, where you can withdraw through checks, or you can withdraw through your instruments. So plus OD, I'm saying OD is the other deposits, the other deposits that you may have, maybe in a quasi-government institution, not only with the bank. So all these are part of the M1 supply of money. So if you know M1 and you know how much is that M1, it means it's the currency at hands and the currency as demand deposit with the banks. M2 is M1 plus saving deposits with post office saving banks. You have M1 which is at hands and DD which is with the commercial banks. You add with the saving in the post office saving banks, that is M2. That means the savings in the post office also can be withdrawn at on demand. So M1, M2, they are similar because you can withdraw on demand from the bank or from the post office. Okay, so M1 and M2, we go down, we'll find that these two are known as narrow money supply. That is the definition, because they include money in as currency held by the public and saved with the bank, M1, and if saved with the post office, that is M2, narrow money. M3 is M1 plus net time deposit of commercial banks. That means you take into consideration the currency, the demand deposit, which is your saving deposits, your current account, at the same time the time deposit, like the fixed deposit where there is a maturity date involved. So those are M3, M1 plus net time deposits of commercial bank. The word net here implies that only deposits by the public held by the banks are to be included in the money supply. Money deposit held by the bank, not the money deposits among the banks, because there is also interbank deposits. We exclude that from M3. Only the deposit of the public with the commercial bank. Banks saving among banks is excluded because they also do save. M3 is very important definition of money supply, and you have to remember it's U plus DD plus net time deposit of commercial bank by the public, remember. And M4 is M3 plus total deposit with post office saving organization. You may have different types of savings in post office apart from the saving account, but exclude the NSC, the National Savings Certificates. All those are part of the money supply. So M3 and M4, they are known as the broad money or the broad money supply. Okay, so these are the definition of money supply by the bank. Okay, in the book you'll find in the last part the different amount of money supply based on these 3-4 definitions. So if you look at compare between these four, you'll find M1 is the most liquid because you can take out any moment you can spend. It's the most liquid and easiest for transaction, whereas M4 is least liquid. It's difficult to use the M4 because it's time deposit. You have to wait till they mature. And M3 is the most commonly used measure of money supply. M3 is very important. It is also known as the aggregate monetary resources. Okay, so these are the 4 money supply that has been defined by the Reserve Bank of India. So what you've learned about how money is demanded and how money is supplied, and by doing so you'll be able to answer some of these questions, like you can define a commercial bank, You can list out the functions of a commercial bank. You can distinguish between transaction demand for money and speculative demand for money. That's the other video. And also you can explain the various concepts of money supply as explained by RBI, M1, M2, M3, M4, but you have to differentiate between those. What's the difference between M1 and M2, M2 and M3, M3 and M4? Those are the different money supply.